Good morning, and thank you for joining us for today's free webinar, Preparing Your Startup for a Capital Infusion, with David Ehrenberg, founder and CEO of Early Growth Financial Services, and Rod Bleacher, VP at Lighter Capital. My name is Jenna Cornell, and I'll be the moderator for this webinar. This presentation will run about 40 minutes. If you have any questions as we go through the presentation, feel free to enter them in the question field. We will answer questions as they come, if we can, or wait until the Q&A at the end of the presentation to address them. If we run out of time, we'll follow up with another email after the presentation to make sure that all of your questions have been answered. I want to start by introducing our presenters today. First, we have David Ehrenberg, founder and CEO of Early Growth Financial Services, an outsourced financial services firm that provides early-stage companies with an integrated financial solution, including day-to-day accounting, CFO services, tax, and valuation support. We also have Rob Bleacher, partner of Lighter Capital, which makes revenue-based loans to small and medium-sized businesses needing expansion capital. David and Rob have a lot to cover today. We want to make sure we have time to answer your individual questions. Let's get going. Good morning, Rob and David.
Thank you, Jenna. Thank you very much.
Hey there.
Thank you, everyone, for attending the webinar. I know that you all are incredibly busy, and hopefully there's going to be some good content in the webinar, and hopefully we will be able to add some value.
Yeah, I have to start off with a quick update on that photo of mine. I'm really excited to talk to you all, but there are now two baby boys in my family. My wife had our second boy in January, so I need to update my photo for the next webinar. But excited to talk to you guys today, and thanks for joining.
Hey, Rob, I didn't realize that. Congratulations, buddy.
Thank you.
Jenna, let's pop to the next slide.
All right, so Jenna gave a quick overview about Lighter Capital. We are an alternative investment company. We are a specialty finance company. We invest in early stage technology software companies. We're a group of serial entrepreneurs, technologists, angels, and former VCs. We've kind of been around the software, tech, and finance space for a long time and see that there needs to be, there's an opening for an alternative. And so enter revenue-based finance, which we'll talk a little bit about today as part of one of the tools in the financing toolbox. And we also are we have a tech component to what we do that helps speed up our underwriting process and our servicing processes and take some of the fundraising pain away. And we are not a bank, we're not a VC. We do a debt product, and like I said, we can talk more about how it works because it is a little bit different than things you might have heard of in the past. And I think that's it. David?
Absolutely. Jenna, do you want to pop to the next slide?
I will jump in and say, sorry, the one thing, just so you have a sense of scope about Lighter Capital, we do $50K to $1 million investments at any one time, and we tend to work with companies doing anywhere from $20,000 a month in sales up to about $1 million a month in sales, and we've funded 40 plus companies now at this point.
Which is great. So Jenna gave a good overview of Early Growth. We're basically an outsourced finance and accounting shop. And that means 4 different things. We do transactional accounting, which is working with companies on their day-to-day accounting transactions. So helping them set up accounts payable, accounts receivable, payroll, making sure that all their general ledger transactions are entered correctly, preparing financial statements, doing general financial reporting, all of the day-to-day work in the accounting world. We also do CFO services. So we have a large number of CFOs. All of our CFOs have worked with several early stage companies prior to joining our team. About half of our CFOs come out of public accounting, where they were managers, senior managers, or partners for Big Four firms. The other half come up from the finance side of the house. So good MBA programs, and then they took financial roles, and then they became CFOs. And they do strategic consulting, budgeting, forecasting, pricing, helping companies raise money. In addition to the CFO services and the accounting services, we do taxes. Pretty self-explanatory, but state taxes, federal taxes, helping companies with things like R&D tax credits and sales and use taxes, all the basic things that fall under the tax umbrella. And then the fourth thing that we do is 409A valuations and other valuation services. So if a company is giving out common stock or restricted stock options or is going through a merger or an acquisition, we help them prepare the financial valuation and all the work that needs to go in to support that. We have about 350 clients. We're in 9 cities across the country, but our client base is nationwide. So even if our clients are not in the 9 cities that we're in, we can support them and have a large number of companies that we do. We work with companies at all stages of development, and although we work across multiple industries, probably our largest customer segment is the high-tech, high-growth space.
Hey, Rob, we had a quick question from the audience for you. Does Lighter do deals in San Francisco as well?
That's a great question. I was actually going to add when David was talking about their geographic presence, we actually fund companies in the U.S. and Canada. So San Francisco for sure.
So through today's presentation, we're going to talk about how to analyze your business. We're going to talk about building a projection and building a business and fundraising game plan. We're going to talk about what you need to do to pull all that information together and get ready. And then we're going to spend a brief amount of time on what are the required documents and the information that you need to get through the process. When you start the process of going out to raise money, you really want to make sure that you have a firm understanding of your business, what you're doing, and where you're going. This seems pretty straightforward and simplistic, but it's very important to have the discipline to sit down and go through these different areas so that you understand fully what you need and what you're looking for, but also that you understand how you can communicate that succinctly and how you can tell potential investors that story in a comprehensive way.
Rob,
Yeah, this is one of the most important.
I have another quick question for you
sure.
from the audience.
Sure.
Does Lighter Capital only fund tech-based companies, or do they do retail or other industries as well?
Yeah, we do only software and technology at this point. We do e-commerce, but usually only if it's a digital product being sold, not an e-commerce with a retail component, a physical good.
But it's probably worth mentioning, Rob, that although you're focused on that segment, there are other companies that do a little bit of what you do in some other segments as well.
Yeah, so absolutely. I guess that's a good point. So that's what Lighter Capital does, right? But revenue-based finance can be applied to a lot of different things, and we'll talk more about revenue-based finance in a minute. It can, if you're familiar with factoring, it's sort of the flip side of the coin to factoring, where factoring finances previous sales. You're financing a purchase order, something that you've actually made the sale, but you don't have the money for yet. We're financing, revenue-based finance is sort of financing future sales or taking a little bit more risk on future sales because you do get paid back out of revenue, but in the future. So it can be applied certainly to retail. People come to us all the time with invoices and POs wanting to finance them, or big contracts with Kohl's and JCPenney and stuff. That's just not what we do. Back to the slide. This is building on what David was saying. This is one of the most important things for us, especially because we're working with relatively small, earlier stage companies that aren't necessarily on the formal VC fundraising track. We work with a lot more bootstrapped companies that want to raise a little bit of money to hire a couple salespeople. And so having this concise, we want to save you time. That's our goal, is to save you time. And David actually really likes this too, because a lot of what they do is help you organize all this stuff. So this is stuff you need to think about and have very concisely and very clearly, kind of being self-aware about who you are, what you've done, what you want to be. And one thing I will say too is being clear about this stuff. The more nebulous you make this, especially to us, like I get on the call with people and some people are boom, 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 here's what it is, and that's great. We can quickly move forward. If you're kind of nebulous about your financials, you're not sure, or maybe you're hesitant to share, it makes it hard for me to help you too, right? Like if you're pretty clear and you're open and honest, I mean, there's, we're a um, we're a financial investor, right? We're not going to share your information. We take security very seriously and confidentiality very seriously, but we need to help you. So help us help you by having this stuff pretty clearly straightened out and communicate it very clearly with us is the most helpful thing for helping you find the right funding option. Because honestly, if we're not the right fit, we'll try and introduce you to someone who might be. But we don't. If you're nebulous or you don't want to share things, like we don't know what to do with you. So be prepared, be proactive, and be forthright.
Hey, I agree with everything that Rob just said. I think that what we see over and over again is if entrepreneurs are talking to potential investors and they don't have a very clear understanding of where they're getting their revenue and how they're going to, more importantly, how they're going to build their revenue, how they're going to acquire customers, what their pricing will be like, and how they're going to obtain the financial growth that they're projecting, the conversations are always a non-starter. Do you want to lead off on customers, Rob?
Yeah, sure. I think all of these things, these questions, drive into the type of financing, right? So, again, kind of like the factoring thing, right? If you have, this is a little bit of sales, but if you have one big customer who's paying you quarterly for contracted work, that's a very different scenario than a B2C company that has thousands or tens of thousands of customers paying you $10 a month or something like that, right? So, knowing who your customer is, how they're paying you, when you bill them, when you receive payment from them, what your default rate is on bad receivables, all that kind of stuff will really set the tone. You may not even think about that, right? Like, oh yeah, bad, but that actually, if you go to a bank and you're looking for a line of credit or an AR line, that's going to drive. That's the question. So you got to think about all of these things together in terms of, okay, so maybe if I've got a lot of do B2C and I get a lot of bad receivables, maybe that's not the right fit for me. Maybe I need something else. So knowing who your customer is, when they pay you, where they come from, especially on the SaaS side, attrition rate, churn, all that stuff is really important too.
And I think on customers, a lot of times when folks are going out and they're raising money, they have their existing customers, they have their existing sales, or it could be that they're pre-revenue and they don't have customers yet, but there's typically a growth plan in place. And it's not just about who are your existing customers, but it's also about who are the customers that you're planning on targeting and understanding who those customers are and what they look like, but also understanding what's their appetite for your product, how quickly you think you can acquire them, and what is the customer acquisition cost and what will it take to acquire them. Making sure that you understand all the components of that picture is very important. Rob, should you kick off sales?
Sure. This is related to customers, right? And I mentioned a little bit of these things. We particularly, because like I said, we're kind of financing future growth. We look at your sales pipeline pretty heavily. And we also, to be clear, we only invest in companies that have existing revenue. Like I said, 20K and up in monthly revenue. So no pre-revenue. I know David works with a lot of pre-revenue or some pre-revenue startups.
A lot would probably be the right way to describe it.
Okay. All right. Fair enough.
It's a good healthy mix, Rob.
Yeah, good. But so that's a very different, kind of setup for this whole talk, right? And so we look at the sales pipeline. You've got your 5 or 6 or 10 existing customers. What does the pipeline look like? Have you had meetings with them? Are any of them huge? Are they all kind of the same size? But again, knowing what's out on the horizon and being able to articulate that and explain that and make it a positive, like I have these opportunities, I need funding to go do XYZ, present at a trade show, how does that all fit in, and what is, like you said, the customer acquisition cost, and then how to drive sales, which drives revenue and drives valuation.
Absolutely. And the last question mark on this under the sales category is how long is the sales cycle? Also understanding how much time it's going to take to bring on those customers and what that process will entail. Because if someone's going to be either lending you money or investing in your company, they need to understand what the time horizon is and how long of a period of time are you talking about? Is it going to be 3 months till you hit your target, 6 months, 12 months? And there's a lot of different factors that drive that. But the more that you understand your business model and the more you understand how you're going to achieve revenue, the more you are going to be a good candidate for a potential investor.
Yeah, this is all kind of profiling your business, right? Like, make it very clear to yourself and to potential investors or, service providers that are helping you. What is the profile? What kind of business are we talking about? A high customer number B2C company, or is it relatively low enterprise sales, long sales cycle, selling into biotech companies or selling into the government? Give me the profile and know who you are and know so I can, help me help you again. And these things all feed into that for sure.
The last category, team, we hear this over and over again, and I'm sure everyone on this call has heard this over and over again, but team is so critical for any type of investor, whether it's lighter capital or an equity investor or a more traditional bank. Everyone is going to be looking at the team, and they want to make sure that there's good, strong business experience, good, strong industry experience, and folks that know how to build a business and that they know how to achieve these revenue and sales milestones that we've been talking about. And that doesn't mean that you have to be a serial entrepreneur to go out and get funding, but it does mean that you need to have some expertise and you need to have the ability to convey comfort to a potential investor in your ability to execute on your plan.
Totally agree. And to the very last point, we actually like when people come to us and they say, "Hey, I've got a VP of sales identified. I want to hire him. I just don't have the cash." That's a slam dunk for us. Absolutely. Here's some capital to hire him, empower him with a budget, and go crazy. And then the other thing about team that's sort of behind the scenes here is just keep in mind that fundraising does take a little bit of time. I mean, we do try and fund as quickly as we can to get you back into the business, but think about your team and whether you're the founder who's a technologist or the founder who's the sales guy. There's usually kind of those two types. There's some in between, but usually one or the other. It's probably going to pull you away for quite a bit. And so when you think about your team and your business, be aware that fundraising takes time and it's going to distract you from either sales or product development for at least a little bit of time.
Rob, I think that's an excellent point, and I think we might touch on it later on in the presentation. But one of the things that's not to make this sound like too much of a sales pitch, but one of the things that's absolutely wonderful about Lighter Capital is that they have the ability to execute incredibly quickly, but that is not the case for most investors. So when we have companies that are going out to raise venture capital, we traditionally tell them that it will take on average 6 months from the beginning of the process to the point that they have funding. I think we talk about this later, but make sure you factor in that time, and that is a huge benefit of working with someone like Lighter Capital is the quick ability to execute in their short timelines. But do plan in timing around your investment planning. If you need money in 3 months and you're just starting fundraising now, that can be very problematic.
Yeah, I think you probably heard it before, but raise money when you don't need it. That's when you'll get the best terms, right?
Right.
Or at least plan in advance before be self-aware and plan in advance till when you think you'll need it is when you can close.
And we all have a problem doing that, right?
Yeah.
It's always hard to plan for rain on a sunny day.
Yep.
I think we can flip to the next slide, Jenna. So the big thing on this, and Rob and I both talked a little bit about this on the last slide, is you want to make sure that you have a game plan around this process, and you want to understand, as part of understanding your business and understanding the different things we just discussed, you also want to have a good, strong, strategic game plan around fundraising. You want to make sure you think it through, you have a plan on how you're going to achieve it and the steps that it will take, and frankly, the resources of your team that you'll need to utilize in order to get where you need to go. Do you want to start going through the bullet points for us, Rob?
Sure. I think, I'll speak a little bit to this to our customer because that's who I know best, but it's true for anybody. Is you obviously have to have a model, whether it's in your head if you're just getting started or if it's actually planned out, for how much you need, right? If oftentimes it's pretty interesting. People come to us and they're so used to the VC world where I need $3 million. Well, do you actually need that, or what do you need? And it's, I need 300K to hire 2 people and give them a budget. And then 6 months from now, I might need another 300K. So maybe they do need 3 million over the next 2 years, and if they were going to raise equity, that's what they would do. But it's really valuable to have a conversation about what do you need 6 months, what do you need a year, what do you need for 18 months, and David and his team can certainly help walk you through that and the modeling behind all of that. And we'll talk about the very last one is probably the most important bullet here: milestone financing. But then, again, that model or that plan is going to turn into how much and what's it for. And then, you could have a separate model for every type of financing you raise, whether it's bank debt, a line of credit with a small term loan, revenue-based finance, an equity investment, convertible notes. The thing I'll say here, I guess this is where I'll say my point about raising money is your cap table is only clean once, right? So this whole webinar is about finding the right funding for you and being prepared for it. And if you haven't gotten it yet, I think the message is be prepared and think really hard about what's the best fit for you, because no matter what it is, you take out a credit card with a 50K limit, it's going to impact your business. I mean, that's probably the smallest one, and it's pretty easy to get rid of. But any type of financing is going to alter the structure of your business. And so that's kind of feeds into these last couple of bullets. But then David and I have some points about milestone financing, thinking that through so that you take on the right amount and the right type of financing now to fund you to your next milestone, so that you can dive into the next type of financing or valuation or whatever you might need at the next milestone. David, I know you've got a lot to say on this one.
No, and I don't know if it makes more sense to say it now or on the next slide, but I think to Rob's prior points, I mean, there's a lot of different ways to bring capital into your company, and all of those different methods have bonuses, and they also have liabilities associated with them. So once again, just to keep harping on the same theme, understand what the different financing options are, understand what the benefits and the pros and the cons are of using that kind of financing, what the terms are, and frankly, depending on the stage that you're at, it really will have an impact on the type of financing that's a good fit for you. Whether you're at a seed stage or a later stage, it makes a big difference. And I think we address that a little bit in the next slide. So let's flip to the other side and then maybe talk about milestone financing there a little bit, Rob.
Yeah, I like that. I think every financing type is a compromise, including no financing, right? Continuing
right, absolutely. Bootstrapping
is a compromise too in itself, right? It's relatively cheap, but it also hinders your growth probably the most. Financing allows you to leverage the business and grow the business. So bootstrapping is sort of the first one. Obviously, a lot of people get started with credit cards and working at night, and then obviously raising money from friends and family, dipping into savings, that kind of thing. Crowdfunding.
Almost every company is going to start that way to a certain extent, unless you have a investor lined up from the very beginning, which very, very few companies have. You're going to bootstrap it when you start out, and that's all about cash conservation. It's spending as little as you can, and it's a lot of sweat equity. So putting in your own personal time, working nights, working evenings, quitting your job so you don't have a salary, perhaps depending on a partner or a spouse to support you. But a lot of firms start in this area. There's not a lot of fundraising options when you're at that stage. It's all about how much can you produce, how much progress can you make on your own labors or the labors of yourself and your other team members. Typically, once you have created something or you have a value proposition that people can understand and believe in, then a lot of times we see entrepreneurs go out to friends and families and raise money. Talking to your uncles, your aunts, your brothers, your sisters, people that you've known for 25 years, raising that money. That's oftentimes the easiest money that you can get, but the amount of money is very small, and it's a scary situation to go out to your friends and family and ask them for money. Oftentimes, they aren't traditional investors. They don't do a lot of high risk investments, and any startup is going to be a high risk investment. So, although this is a necessary way to raise money, it's in very many respects a necessary evil because it has a huge drawback. You don't want to waste $50,000 of grandfather's money.
Yeah, the con here is definitely straining relationships for sure, and especially
Right.
if they don't understand
It's a
what to do.
relationship con. It's a total
Yeah, for sure.
relationship con.
Yep. Yep.
Do you want to talk a little bit about? Should we jump into operating? Should we just go down this slide, Rob? Is that the best way to tackle
I
it?
want to hold off on operating for a minute because I think it's kind of an interesting one. I think angels and VCs are kind of the most common, at
Yeah.
least to the audience we're talking to about startups and technology companies for sure. And even angels invest in all kinds of stuff, right? Back to the question about physical goods, retail. Angels get excited about all kinds of stuff. Smoothie restaurants and stuff like that. They can get behind a lot of things. So angels and VCs are pretty well covered. VC certainly can run the gamut, right? I guess even just saying I'm going to go raise equity from a VC, I think the one point, this sub bullet here, VCs have different strategies, right? So you've got to still target who you're going to go talk to. Later stage growth equity guys are not the same as VCs that are dipping down and have a seed stage fund or something. So still kind of refining what you need and from whom is important.
Yeah. So I'm sorry. The angels really fall into two categories, maybe three categories. An angel investor can be someone that you know that's a high net worth individual that does some occasional investing, or it could be an angel group. And there's been a proliferation of angel groups within the United States over the last 10 years. So most major metropolitan areas now have angel groups. And then there's also some national angel groups like Keiretsu that people can join. Typically, for an angel group, you would go in, you would present your business plan. You would, if they were excited about you, you would go through several different rounds of due diligence. It's a method for raising money, but people should understand that the angel route oftentimes takes a long period of time. It's perhaps the longest way to raise money. And oftentimes you're also dealing with unsophisticated investors, which can be a little bit difficult. And you often have to have multiple angel investors in order to obtain the amount of financing that you need, which can be a bit like herding cats. So if you need to raise $500,000, someone like Lighter Capital or a venture capital firm or a traditional bank can give you all of that money. But for an angel group, you may need to have 10, 15, 20 individual angels to get to that $500,000 number. And what that means is instead of managing one external investor relationship, now all of a sudden you could be managing 10 to 20 external relationships. It's a way to raise money at the very early stage. It's one of the few options available. So I'm not saying don't do it, but there's some real negatives around angel investors and getting that kind of money in. And
Yeah, if I can chime in here, angels
absolutely.
are really they're a necessary evil, I think, and I kind of agree with you. I think they fit a really important place in the financing in this chart, right?
Yeah, they have an important role in the ecosystem.
Yeah, for sure. I think all of those points, if I could echo them, are so important. Anytime you do any additional financing, you're going to need to get signatures from all 20 of those angels. If you want to sell the company, if you want to do anything, like I said, your cap table is only clean once. And the other, the initial diligence and funding process, like you said, David, is just slow because honestly, these guys and women are successful executives who have a lot of money and now want to play venture capitalists and want to see deals in their spare time, but don't want to do any of the work. They want to touch and feel and see and get involved in the community and hear about that startup before anybody else did, but not actually do any of the work to fund the company, right, and do the diligence. So, you'll have 10 people interested and no one's taking the lead to actually pull all the docs together and all that stuff. So it's a necessary evil. I will say most of you will probably raise money from angels, but just be aware of what all it takes. And if you can, I think fewer is better, fewer bigger, more committed, more active, more involved is better.
Yeah, and we are seeing the growth of what we call super angels. And these are folks that are writing bigger checks and are more sophisticated investors and understand how the ecosystem works and how companies typically work. And they have extensive background in working with early stage companies. But a lot of these super angels also have terms that are much more disadvantageous to entrepreneurs than any other form of capital. On the VCs, I just wanted to also echo Rob's point, and I think we have a slide where we're going to address this a little bit, but to say you're going to raise venture capital money, that can mean a lot of different things, and VCs are very, very different, and all VC firms have a focus, and they have a focus on industry, on business type, on the stage that you're in, and also geography. So making sure if you do go out to, or if you're thinking about raising venture capital and you are targeting VCs, also understand who are the VCs that are a good fit for you. Can I chat really briefly about crowdfunding, Ron?
Yeah.
So there's been a lot of press about crowdfunding over the last couple of years, and the new jobs bill, or not necessarily the new jobs bill, but the jobs bill that Obama and Congress are trying to enact has a portion on it devoted to crowdfunding. We've been waiting a long time for that to come through, and it could have a big impact in the future on fundraising. But right now, it's still there's a lot of gray areas around crowdfunding. But there are different crowdfunding platforms that are out there, and Early Growth has some clients that have raised a significant amount of money on crowdfunding. Probably our largest one is an LA-based company, Ouya, that's raised $8.7 million on Kickstarter. But this is an area where I think there will be some growth in capital generation, but we don't know how it will fall out and how it will shape out. But if you talk about angel investors and you talk about herding 10 or 20 cats, when you're talking about crowdfunding, take that number and magnify it by 10 or 20x. So, there's going to be some difficulties around crowdfunding, but it is an area that we as a firm, and I'm sure Rob and Later Capital, we're all looking at this closely to see what happens with it and where it morphs. So it'll be interesting to keep an eye on.
Yeah, I mean, it's kind of funny. I mean, the way that it looks to me right now is basically like, David, you and I, before the webinar started, we're talking a little bit about preparing for an IPO. I mean, it's a lot of work for a company doing $50 million in revenue and with tremendous resources. And crowdfunding, kind of in the future, what it's proposed as, is sort of like going public when you're a tiny startup. And it's just a tremendous amount of work. And the IR, like you mentioned, is just incredible.
Right, and I think the other thing that we're going to find difficult with crowdfunding is, how do you differentiate yourself from the other, 10,000 companies that are trying to raise money on a crowdfunding platform, and exactly, what does that mean, and what does that look like? Right now, it's very nebulous, but it's worth mentioning because it could be something that could be very significant in the future.
Yeah, or if you're a product company, Kickstarter is great, right? I mean, if you do want to,
Ouya is a product company. Right, so they're selling a video game console. So it makes sense.
And that's a great way to get started for sure. Get the product financed. I mean, it's great.
It's pre-sales.
Yeah, yep. Strategic investors, moving on, is a really interesting one. If you are so we work often with a lot of companies that are on the Salesforce ecosystem. They have apps that are in the Salesforce App Exchange, and they're bolt-ons to CRM, or they're using the Force.com platform and writing software that has nothing to do with CRM, but are using that as basically an ecosystem from which to just very easily scale up a product. And those kind of, like, I mean, if you're building something really cool and it's really valuable to the ecosystem and you're aligned with one of these big strategics, it's a place to think about for sure. Most of the big tech companies, and even doesn't even have to be tech, anything, GE, ExxonMobil, all these guys are going to have a corp dev group, and they certainly make small strategic investments in companies that might one day or even today be very valuable to their ecosystem. So something to think about, and by no means are they well, two things. One, they can be one of your only sources of capital, and you're set for life. You're also kind of hooked in for life in some ways, so that's the con to the pro and con there. The other sort of flip of that coin is that oftentimes they don't provide all of the financing, right? Almost all these strategic guys are followers in rounds. They won't ever lead a round. So that's the con, is it's relatively small, but certainly having Microsoft be a co-investor in your equity round or whatever it may be is not a bad thing.
Should we jump into one of the next categories?
Yeah, sure. I think quickly, I can talk quickly about banks. I think the dirty little secret about banking is that they actually only lend to companies that don't need it. And even Silicon Valley Bank, which we love, we're customers, they're friends of ours, they lend to companies that are pretty established. They won't lend to very early stage growing companies. They lend to companies that are well into the millions of revenue, several years of profitability. That's just who they are. I mean, their funds are federally guaranteed, right? They have very strict underwriting criteria. So that's just the nature of the banking thing. And even if you're talking to Square One or Silicon Valley Bank, you need to be aware of their limits.
Yeah, and I chuckled when Rob was saying his first statement, because it's true. It's as terrible as it sounds, and that goes back to this whole idea of, when it's sunny, you need to think about rain. But that is very true with bank debt. It's almost impossible to get credit from a bank when you're in a scary situation. So if you do think that bank financing is going to be a part of your fundraising strategy, and you should definitely think about it, because there's a lot of advantages to bank financing. But if you do think bank financing is going to be part of your strategic fundraising plan, you need to make sure that you obtain that capital and you bring in that credit at a time when your business is very healthy, when your P&L, when your profit and loss statement is very positive, and you need to plan out bank financing many, many months before you need it. Because when you're in a scary situation or when you're in a cash crunch, a bank is not going to be your friend.
Lastly, we'll talk about revenue-based financing and how I think the operations of the business actually play into a financing solution also. Cash always is king, right? Cash runs businesses, but even more so with SaaS businesses, we've found, does cash and accrual accounting diverge so significantly. And so something to keep in mind is a source of financing is getting prepayments. If you can get annual prepayments, and in order to get it, if you can convince somebody to sign up for an annual prepayment by giving them a discount of 15%, well, that's your cost of capital, right? You have just succeeded in getting financing for a year that you normally wouldn't have had, would have been spaced out over the course of the year by offering a 15% discount. Something to think about in getting terms from your customers, and then also obviously vendor terms have been around forever. Trying to prolong when you pay your vendors is a way to basically increase your working capital also. Revenue-based finance fits into that because we call it revenue-based, but it's actually, we look at cash and when you get your cash receipts, and we lend based on your cash amounts. We invest in companies that are, and so I'll talk broadly about revenue-based financing. Like I said, there are providers out there that are doing all kinds of different things. They finance life sciences companies, they finance physical goods. I'll speak mostly about us. We finance companies that have traction, have customers, 15 to 20K in revenue and up, and are established and growing and want to use funds to grow. They can be deficit spending. They don't need to be cash flow positive but we have to have some. We're not an equity investor, right? We're not financing to the next round and to the next round with growth and deficit spending like that. But we do have some appetite for burn. It usually can't be more than 6 to 12 months of burn until the companies break even. We offer $50K to $1 million, and it's structured as a loan with repayments based on revenue. If you go to the next slide, Jenna, we can just jump into it. Unless, David, I don't want to cut you off if you had more to say on this slide.
No, I think this was a good overview. If anyone has any questions, go ahead and just write them in, and Jenna will interrupt Rob and I and bring them up.
I have a
But
couple questions from the audience now if you guys want to go ahead and answer these while we're still on this slide.
yeah, let's jump into those questions and then we'll go on, Rob. Is that cool?
That's fine. That's more
Perfect.
valuable.
So what are some terms of friends and family financing, angels, VCs, in terms of what investors get for their money, kind of the equity range entrepreneur gives up?
So that's a difficult question because it really varies. So typically, the earlier the stage of the round, so if it's the first money in, the investors are going to get a much larger amount of the company than they would at a much later stage. So, for example, if you're starting out your company, and these numbers do not use these numbers as a benchmark at all, but if you're raising $250,000 at an angel round, your angel investor may get 25% of the company. Whereas if you're raising $250,000 and you've been around for 3 years, the investor will get a much smaller percentage of the company. So it really depends on the round that you're in and the stage that your company is at. But valuation and equity percentages, really, it's a negotiation. So there's not a set price that you can put for the value of your company. It's going to be dependent on what people think your company is worth. And that's got a huge range of value, but you need to think about it in terms of a negotiation. The more people that are interested and excited about your company, the more people that want to invest and that want to give you money, the more leverage you have, the stronger your position is, and the higher your valuation will be. So we've talked a little bit about thinking about fundraising as a business development process and being strategic about it. But the more people that are, and that ties directly into this, the more people that are interested, the more people that are excited about it, the more you are going to be able to demand a higher valuation. In terms of terms, typically angel investors and venture capitalists will either take equity in the company straight out, or they will put in place a mechanism called a convertible note, which is debt initially, but it will convert into equity at a later stage. And there's some very typical terms that we're seeing around convertible notes out there. But once again, the valuation really is dependent on the excitement for what you're doing and the number of people that are interested.
And valuation is just one part. I mean, I think that's the big one everyone focuses on is, what's my dilution? But, I mean, there are tons of other terms in a VC term sheet, including liquidation preference, board control, protective provisions, downside scenario ratchets, all kinds of things that are going to impact the economics in various situations. So,
Can I say something on that, Rob, really quickly?
Yeah.
One thing that we should have talked about when we were talking about the venture community, so a large percentage of our clients are venture-backed companies, and we are very entrenched in the venture ecosystem. But venture capital is one of the worst kinds of capital to get because venture capital comes with a huge cost of ownership and cost of control. Now, in a lot of situations, venture capital is your only option. If you are pre-revenue or have very little revenue and you want to have a high growth company and you need to build infrastructure quickly, venture capital is likely a good fit for you, but there are huge downsides to venture capital in terms of giving up equity, giving up control, and there are a lot of components, as Rob said, that are in a venture term sheet that are not to the advantage of entrepreneurs.
Yeah, it's a marriage. I think that's been written about is that VC investment or an equity investment's a marriage. They're in there forever, right? Your cap table's only clean once, and you can't get rid of them. I mean, there are really severe ways to get rid of them, but that's really ugly. It's something to not take lightly. You think that raising the money is making it. Raising the round is just the beginning. That's when the work starts. By no means is that when I think I've always thought that raising a round and popping champagne and all that kind of was misguided, because that's when the work starts. That's when the marriage begins.
Right, and it's always happy at the beginning of the marriage, right?
Yeah. Yep.
Jenna, do we have a second question?
Yeah, as a follow-up to that one, are there guidelines and how-to principles on setting a starting point for a valuation negotiation?
There are some principles and some guidelines. A little bit later in the presentation, Rob and I are going to suggest some books that are out there. And we've done a couple webinars. Early Growth has done some webinars on this subject that you can find on our website. There are some guidelines and some principles, but it really, once again, depends on how much excitement you have and how much interest you have.
So I've heard something that I'll share with you guys that I think is kind of an interesting, because doing a series, so Series B, C, D, E, F valuations, there's so much more that goes into it, and David, I'm sure, could write a book himself if he wanted to on valuing, and obviously you do the 409As and all that stuff, valuing later stage investments. For earlier stage stuff, something I'll share with you guys that's kind of an interesting behind the scenes thing about Series A is valuing a Series A investment is really hard, right? There's no previous valuation. There's very little revenue. Where do you start? And that's the question. Where do you start? Someone shared with me once that if you are raising a Series A, say call it $4 million, or call it $3 million. You're raising a $3 million Series A. Series A investors, VCs, usually want 25 to 40% ownership in the company. So by the very nature of the fact that you're raising a $3 million Series A, the company is worth $8 million, right? Or 7 or something like that. And so it's self-defining in the sense that because you are where you are and you're doing what you're doing, you're worth that amount, if that makes any sense. There's no way to say, oh, your idea is actually worth 12 because you're special. That's not the case. It's actually more of, because you are where you are, this is what you're worth today. I mean, that's a gross generalization, but it's an interesting way to think about Series A. Now, if you're raising a $10 million Series A, yes, perhaps there is something unique about what you're doing and it's very different, and so you're worth some different amount. But again, they're going to want 25 to 40%, so you can imagine that your company's probably worth, if you're raising a $10 million Series A, something like 25 to 30 million bucks or something like that. Yeah. That's one way to think about Series A.
And it's not an art. It's not a science. It's an art.
It's an art. Right? Yeah.
That's, I guess, what I'm trying to get at. We've gotten ourselves in trouble on time.
Yeah.
So let's flip.
Yep. Little pros and cons comparison of revenue-based finance to bank debt and VC. I will go through this very quickly. Revenue-based finance, at least our version of it, is a hybrid between the two. So whereas venture capital has very strong controls and guarantees because and banks have the personal guarantees, that's all they have. They have no actual financial recourse. We have very limited, but their big pro is they do lots of mentoring and they are massaging the company and helping you grow and providing introductions. We do ask for a small success fee. Obviously, equity is the way venture works. So on the dilution side, we're very small. We're very flexible. And then the big thing is speed. We work really quickly.
And that big thing really matters to a lot of our clients. Yeah. So it's one of the reasons why we're big fans of lighter capital, just because sometimes when you need money quickly.
And it goes to this whole webinar, right, of being prepared. Because you might be prepared, but banks and VCs are still going to take their time.
Yep.
So this is quickly how it works. It's a revenue share is how the repayments work. You might borrow 100K from us, so you owe us 100K plus interest, and you pay us a fixed percent of your revenue every month until you've reached that amount. And that usually is about 3 years, 4 years is what we shoot for. It's a term loan. It's growth financing. It's not meant to be paid back in 6 months. It's not bridge financing. It's growth term loan. It's an alternative to angel or even equity. Next.
So, what I think might make more sense, Rob, if you're okay with it, is there's some information that we have available on what you need to pull together to do a fundraising. There's a couple different webinars that we have that are on our sites that cover this area. It's become very traditional what you need to have when you're going out to raise money. And each of the different folks that you talk to require different levels of information, and they want to have that information prepared in other ways. But in consideration of time, what I would suggest is we've got 2 different webinars on our site that go through what it means to pull this information together and what you need to have. I would like to suggest you go to our site and take a look at that. If that's okay with you, Rob.
Yeah, that's great. I think we've covered a lot of this, and we do have sort of 5-10 minutes left. I mean, I think question and answer may be most useful. We also have more detailed webinars, videos, information about revenue-based finance specifically. So if you have questions about how it works, who it's for, what's the cost, all that stuff.
Let's just go through, Rob. Why don't you flip through really quickly, have Jenna flip through, and you can talk to the different things. The last set of slides, just don't spend much time on it, but let's just do 2 minutes flipping through it. So yeah. Key slides, that's contained in the information we have on both of our websites. But
yeah, this is the basic stuff, but it's you need to see a list somewhere, so we provide it. This is actually yours. Do you want to talk about how to kind of?
I don't. I mean, there's going to be financial projections that you require for raising any type of funding. It varies whether it's revenue-based financing, a bank loan, or it's a venture capitalist. This slide is very specific to venture capitalists. We spend a lot of time. We have a presentation just on building financial projections, and that's on our webinar. I mean, we have a webinar on that, and we also have several speeches that I've given on this topic. All that's on our website. This is once again talking about it. It's a business development process.
Yeah, treat it like a sales pipeline. I've heard even it's usually you start with 50 some odd or more hundreds of people that you want to talk to, and you end up raising money from 3.
Oh, really quickly. So we referenced some books earlier. There's a book called The Art of Start, which is by Guy Kawasaki. Guy was the first evangelist for Apple, and he started GarageVentures.com. He's a great guy and a real character in Silicon Valley. The Art of Start is about how to raise money. It's about a lot of things, but he spends a lot of time talking about how to raise money and what you need to do. The second one is by a very close personal friend of mine, Mark Phillips, who's also a venture capitalist. It's called The Insider's Guide to Silicon Valley, and provides a lot of good information about the fundraising process, but very specific to the venture community. And Rob, the third?
Yeah, the third one is my recommendation. It's called Early Exit, and it's by an angel investor out of Vancouver, BC, named Basil Peters, and his whole premise is on. I mean, I'll be totally blunt with you. He says sell your company for 10 or 20 or 30 million dollars, and only ever take angel or early stage investment, and own 80% or 90% of the company, and start over. Do it again. Trying to raise $10 million of VC and build a $1 billion business where you may end up with only $10 million in the end of the day anyway, it's a much, much harder road to hoe to try and build something that big. It's going to take so much longer, and so it's just more efficient and faster and easier and more fun to start a company, take a little bit of financing, grow it, sell it, start over. It's a really interesting take on the VC world and the startup world and what the expectation should be.
The rest of the deck is, the rest of our webinar is just on the things you need to pull together for your fundraising process. It's just basically a laundry list of stuff that you need to have.
Yeah, let's go to questions. I think, we'll post this, and it's the standard stuff that anybody's going to look for. It's more documentation. So I think questions is a better use of the last couple minutes here, if there are any.
Sounds
We could have
great.
answered
Yes,
everything.
we have several questions. So, if you are an early stage startup and get an extremely small amount from a friend or family member, approximately like 4,000, and they get 0.1%, does that pretty much mean put your valuation at 4 million?
So if you are raising from friends and family, set a minimum for how much you raise so that you don't have to deal with 4,000. Try and set a minimum. A lot of times we see that minimum at 25,000, but it can go down as low as 10,000. So first of all, avoid the 4,000. Second of all, bring the money in as convertible debt. And there's a lot of information out there on convertible debt, but don't set the value at that stage. They will get
Yeah.
yeah.
Sorry. Yeah. So I didn't want to talk about Series B, C, D, and E earlier, but this is the point that I was going to make. If you have given somebody straight up equity for $4,000, you have set a valuation, and yeah, I think I didn't do the math, but I think what I heard was it does sound like 4 million bucks. And so if you ever go try and raise money again,
You set your floor.
that's your
Like,
starting place, and you're screwed. Like that's a relatively high starting place depending on where the status of the company is. And so that investor is probably going to get crammed down, and it's going to be ugly. Like David said, like keep it as flexible and as as limited as you can in terms of what you're doing. I would just write that a note, right? Like pay that guy 12% or something. Or you give him some bonus if you buy him out early. Structure it really flexibly.
yeah, or convertible. Convert it at a
Yeah,
later date when we have a real equity
totally.
round.
That's the easiest.
Jenna, we probably have time for one more question, but then get the questions and we will respond to each of them.
Um, is it
And
unreasonable to ask for an NDA to be signed by a potential investor, whether it be VC or venture debt firm, prior to sharing the investor deck if you have a distributive technology product
so
that the developer.
if you're raising money from venture capitalists or venture debt firms, they will not sign an NDA. So
Thank
it's
you,
not a
David.
question of whether it's reasonable or unreasonable. They just will not do it.
I want to know. So I'll put the question. I mean, not that you can respond, audience, but why do you want an NDA? Yeah, okay, maybe it's something that's revolutionary, and you think. I mean, do you think a VC is going to go start that company? If it's just because you've heard that that's the expectation, I would get that out of your head, like David said. I mean, it's
They
gonna.
won't do it. They just
I'm
won't.
gonna I'm gonna
It's not
have to
even
have
a
my
question of
legal
whether or
counsel
not to
look at
go
your
ahead. Yeah,
NDA and
yeah.
go over it and give me feedback. It takes too much time. It's too expensive. It slows everything down. There's no point to just have a coffee and talk about your opportunity.
Yeah. And they just won't do it. They won't do
Yep.
it. VCs won't sign NDAs.
Yep. We don't either.
Yeah. Early growth will sign an NDA.
Yeah. Yeah. That makes. I mean.
I sign NDAs every day.
Yeah. Yep. Yep. There's just no point for
Okay.
the amount of deals that investors see. Especially we look at SaaS companies all the time. The chance that somebody's doing something similar is, possible, but we are very, like I said, we take confidentiality very seriously.
So Rob and we both talk way, way too much, and I'm sorry we didn't do a better job of time management on this, but I hope it was useful for everyone. So thank you very much.
Yeah, thanks. Do send in your questions. I think there's probably a survey too that'll go out. Anything you have follow up, and then I think we have contact info at the end of the deck somewhere that will also be posted. In any event, I'm sure you can figure out how to reach us. We'd love to chat more.
Hey Rob, can you
And
stay on the line and can we go into our private screening for just 2 minutes? Jenna, can we make that flip?
I believe so. So all of the questions that got sent in that didn't get answered yet will be emailed to everyone. So you'll be able to see all questions that were answered during the presentation. Um, the presentation will be available this afternoon on the Early Growth YouTube channel, and will also be emailed to you in the next 2 days. So I hope that is helpful.
Fantastic.
Thanks, everyone.
Thank you. Thank you.